Good morning. I'm Randy Barkley, and that's Jeremiah Lee, and we're here to help you discuss and hopefully find answers to some of the more tough questions, financial issues that you're facing in your life today.
Randy and I are both certified financial planners, and I'm also a California licensed attorney. We work together at Tricord Advisors, where we help clients build the life they love.
You know, the thing that we're going to be talking about today is not a subject matter that's easily understood, but in our profession, we refer to it as sequence of risk. Now, you will understand the consequences of that comment, because if you retired at a time when the market started to go down and you had to take out monthly income or some kind of return from your holdings, but your portfolio is continuing to decline in value, that is a negative sequence. Where on the other hand, if you retire and the market continues to go up, that's a positive sequence. Now, clearly, what we don't want to have for our clients is have a negative sequence of return, because as you start to take money out of your account, you're taking a lot more of the principal out of your account, and it could have consequences, negative consequences, later on down the line when you need to have your income grow because of inflation and other things that go on in your life, right?
And the hard part with a lot of this planning is that people retire when they retire. You know, they might adjust it by a couple of years, but when you're ready to retire, often people say, do I have enough? Can I retire? But then the moment, often people aren't going to delay 4 or 5 years just because the market's down. So there's a few ways to deal with this, but the very first one is what most people do anyways, and most planners do. As you start approaching retirement, there's a shift in the allocation. When you're in your 30s and 40s, you're full growth and you're progressing in the stock market.
And you can tolerate the volatility.
Yeah, it goes down. It's no big deal. It's going to go back up.
Because you're accumulating more assets. Obviously, if you're putting money into a 401k or other retirement plans, you're acquiring those assets when they're cheaper because they're going down in value. And that builds additional value into your portfolio at that time.
Yeah, that's great. That's growth. But as you get close to retirement, 5 years out, 10 years out, a lot of folks and a lot of these target date funds start shifting naturally. They shift in that they shift to either bonds or dividend paying funds, and they take out some of the risk. And the whole point of that is as you get right into your retirement, those first couple of years before and the first couple of years after, they want it to be nice and stable. And the reason for that, the big reason, is this sequence of returns concept. And the way this works out is if you had a portfolio that had really high returns at the beginning and then poor returns at the end, and then one that was flipped that said really poor returns initially, really large returns at the end. If you're not taking any money out or putting any money in, the math comes out the same. It doesn't make a big difference. However, if you are taking money out and you have poor returns at the beginning sequence, it is significantly different for the long-term outcome. And that's why people, when they first walk into retirement and start using their funds, we want that to be, if nothing else, stable, ideally growing, but if nothing else, what we want to avoid is a couple of hard years right as you walk into retirement.
So how do you handle retirement when you're entering into a bear market? Now, again, everybody had different views and thoughts, but the first thing you want to do is do a reallocation. You want to review everything that you have. Now, in 2022, we had a different bond market than we've had probably ever since I've seen in my career. The bond market the interest rates were going to start to rise, but we were heading into a recession. Typically, the exact opposite occurs. You start to see interest rates rise and the recessionary rise. You don't have the exact opposite. Mm-hmm. And with interest rates rising and recession looming on the horizon, what you had is bond values going down. They were getting marked to the market, and bonds haven't provided what I consider a lot of stability in this last 6 months or so. But bonds will heal provided that you build a bond tent. And it's really important how you structure your bonds going forward in this period of time, right?
Yeah. So people who retired 2022, it's a hard moment. It's a hard moment for a lot of folks, not because they have a problem, but just because of what they anticipate. So what we're dealing with a lot of clients is because they retired, because they're here, their life stage brought them to retirement. It doesn't mean they're doomed. It simply means they need to be a little more mindful. So the first one is if they were going to put a new roof on the house, so they're going to do some big expenditures, let's delay those until the markets heal. For a lot of folks, retirement is not a 2-year thing or a 1-year thing. It's a 20 to 30 year adventure. And you can still take a long-term approach and let things heal. You just have to be mindful of what you're taking out. The aspect of bonds, if you have good bonds, holding on to them. waiting for them to recover, waiting for them to heal, so you get back to a place where you're able to take out what you need for retirement. The other aspect that we do a lot with our clients, and it's kind of this cash bucket idea.
Right.
If you walk into retirement and your first month of retirement, you need to take money from your retirement account into your checking account to live, you are almost a hand to mouth from your retirement account, which you may have plenty of money, but every month you're going to be taking, good or bad, taking from your retirement account. A lot of our clients, as they approach retirement, we want them to build up a cash account that could just be 1 year, but could be 2 years, could be even 3 years of cash that they're going to need. What that allows them to do is, if the market is just nice and high, let that cash sit there, no problem, take from their retirement account. If the market goes low, not to touch their retirement accounts and just live off of that cash.
And you replenish that cash account later on. In other words, when the market recovers and goes back up, you can take more money out and you can replenish that cash, so to speak, that security blanket.
Yep.
And fill it back up, fill that bucket back up with money that you can utilize at another time. But the whole issue is, how do you stabilize the income flow without jeopardizing the underlying values, the underlying investment returns, the values in your portfolio structure?
Yep. And part of the reason we get to 2 to 3 years, which for a lot of people, say if you were living off of $80,000 a year, and you had 3 years, that's $240,000 sitting in cash. That's a lot of cash just to be sitting there. But the purpose of that is to allow people to weather that storm and without having to dip into their accounts. So for we look at historically the downturns, the corrections, the bear markets. If we look at bear markets and corrections together, they usually have a dip of 20%, so a 20% decline in the market, and that lasts 17 months, so about a year and a half. So for normal corrections plus bear markets, you can survive that without any issue. With a deep bear market, the average of that is 35% down. That's a big chunk down, but the average is 40 months, so that's just a little bit over 3 years,
right,
under 3.5. And so
that would be a worst case scenario.
That's a worst case scenario. So our clients, if you had 3 years worth of cash as you entered retirement.
And remember, the cash comes into account. In other words, we go back and look at your basic needs, and we back into that what you're receiving in fixed income. For example, Social Security is a big part of retirees' income, and we bring that back into it. So we start subtracting from that cash account the fixed amounts that we know that you're going to get. So you may need $240,000, let's say, going back on what Jeremiah was saying earlier. But when we take out the pension, the Social Security, anything else, maybe that fixed account is $100,000 because you know that you're going to get this other income to you no matter what, and you can depend upon that to counter any kind of downturn.
Yep, and that buffer allows a lot of clients a huge amount of stability and confidence in their finances walking into retirement, knowing that if they get a great sequence of returns, perfect, they can deal with it. If they get a really poor sequence of returns, that's fine too. We'll deal with it with this cash buffer. And it's an aspect that as you look to retirement, most people in retirement don't want to ride the choppy seas. They did that in their 30s, they did that in their 40s, they watched things go down, they watched things go up, and they were still working, so it was fine. But as they get into retirement, we want that ship to be much smoother waters. And one of the ways is a cash bucket. The other way that we haven't talked about yet is kind of shifting to dividends.
Right.
There's an aspect that bonds historically, provided this buoyancy into an investment account, and they had this regular income. That has not happened the same way in the last few years. So one of the ideas is to take a sleeve and put them in dividend-paying stocks. And these dividend-paying stocks, they get some capital appreciation as well as potential downturns, but they pay out this regular standard dividend. And if a client is able to live off that dividend, those payments coming out, and not touch the principal or just touch a minor amount of the principal, then whether the stock goes up and down is to some extent inconsequential. Like, they can just live off of those. And examples being Costco, Nike, Procter & Gamble. Coke is probably a good one. Coke pays a 2.8% dividend right now. And so if you had
a pretty safe dividend, it's not going to be a dividend that's going to disappear.
Yep. It's a safe dividend, and it's a safe company. In the midst of the pandemic, I'm sure their sales have fluctuated, but generally people are still drinking Coke and Coke products, and them as a company, they're still paying out a dividend. And so as part of your portfolio, if you hold a big chunk of Coke and you're getting 2.8% as a dividend, kind of this quarterly or annual payment, if you're able to use that for your needs, you don't have to worry about whether the price of Coke is going up and down as far as a stock. You just live off the dividends. So in building a portfolio, part of it is growth stocks, all the things we've had, value and growth and regular stocks. But a big part of it is dividend stocks, especially as you approach retirement.
Another part of your portfolio, we haven't talked about this in this particular segment, but it's something we deal with all of our clients, and that is real estate. And if you have rental property, we try to get that rental property either completely paid for. We try to realign the assets so that we can pay off the debt so that you end up with a property that it's 100% yours. In other words, you're not paying a mortgage. And under Prop 13 in California, your property taxes are going to be lower than if you're in other parts of the country. And the income, if we look at rental incomes, they have remained pretty consistent through good times and bad times. But if your property, again, that's the same concept. The property values may go up and down based upon the market, but if the rental income remains the same, and if we do an analysis, we help our clients look at what kind of maintenance issues do we have to do, any kind of capital improvements. We try to get that done as much as we possibly can before you step into retirement so that you can receive that income unencumbered, so to speak, and that becomes part of that income flow. Becomes things we look at. So
yeah, and a big part of this is people look at retirement is a holistic picture. You're going to have likely some Social Security, potentially some pension income. There's a number of other factors that you want to consider as you build your plan. And what I think is difficult for clients is when they think the market's gone down, therefore my retirement is doomed. And it's a much more complex picture. And there's a lot more, even in the guts of your investment account, of how to structure that so that having a retiring in a bear market doesn't have to be a problem. And then part of it's just a planning to make sure you're on course for that.
Yeah, diversification obviously across the board gives you more security going into it. So whether or not you have $500,000, $1 million, $2 million, whatever it is, the dollar amount is going to be affected, or the use of that money is going to be affected by other kinds of fixed incomes like Social Security, rental income that you have from real estate, dividend paying stocks, and your non-qualified accounts, plus your retirement accounts. All these things kind of come together. It's not as critically important that you concentrate into one area or not. Like somebody says, where am I going to get my income from? Don't worry about that. We'll build out that balance. We are concerned about reallocation. Obviously, what happened over the last several years is there was so much concentration of these big mega cap stocks. These big mega cap stocks are the ones that have been terrorizing the overall stock market this year. They're down anywhere from 30 to 50%, in some cases greater than that. And they're the ones that if people had too much concentration in these particular stocks, their portfolio is going through a tremendous amount of volatility.
Yeah.
Whereas if you diversified away from them or diluted them, in some cases, the portfolio structures are not going through all this chaos right now.
Yeah, and I liked your comment that a person's retirement portfolio deals with their cash, it deals with their real estate, it deals with their actual portfolio, and it's a good thing to look at. Well, if you have a topic you'd like us to discuss on a future episode, you can leave it on our website. You go to retirementunlimited.com, use the comments button, or you can give our office a call. It's 951-684-7011.